Most retail traders focus on indicators. Institutions focus on price. They don't chase RSI signals, they don't wait for 5 moving averages to line up, and they definitely don't trade based on opinions. They trade order flow, liquidity, imbalance, and structure. In this video, I'm going to show you 5 price action tips that will completely change how you read the chart, and more importantly, how you execute. These aren't textbook patterns, these are structural behaviours you see when large money moves the market, the footprints, the intent, the positioning. If you start thinking like institutions instead of reacting like retail, your trades become clearer, your entries become sharper, and your risk becomes more controlled. Let's break down 5 ways to trade price action like the institutions. Alright, let's start with the first one, and this alone can completely shift how you see the market. Use psychological levels instead of traditional support and resistance. Here's why. Support and resistance levels, they're subjective. You might draw them one way, another trader draws them differently, and suddenly you're both seeing completely different markets. That's a problem. Psychological levels, on the other hand, they're static. Everyone sees them. They're clean, they're simple, and most importantly, they're where major institutional orders tend to cluster up. These are the levels the banks care about, hedge funds care about, and where liquidity builds up. When price gets near one of these big round numbers, that's where the game really happens. Stops get hunted, orders get triggered, and momentum often shifts. So instead of wasting time arguing with yourself over where support and resistance might be, focus on what the big players actually use, psychological levels. They give you structure, clarity, and real confluence with the order flow. And trust me, once you start building your zones and trade ideas around these static levels, you'll immediately notice your entries get cleaner and your confidence will shoot up. Let me show you exactly what I mean. If you pull up a chart of Euro USD, you'll see something fascinating. Price constantly reacts around clean psychological numbers. You'll notice it rejects these levels multiple times, sharp reversals, consolidations, or big breakouts, even when there's no obvious support and resistance level nearby. That's not a coincidence, it's market psychology in action. Traders, institutions, and algorithms, they all anchor around these big memorable numbers because they're easy to see and easy to act on. Humans naturally round numbers. We like order, we like symmetry, and that behaviour shows up in price. And here's the kicker, this isn't just trading folklore. Studies on psychological levels have been around since the 1960s. Academic papers have tested thousands of price movements across forex, equities, and commodities, and the conclusion is always consistent. Markets do cluster around round numbers. So when you see Euro USD bounce perfectly off 1.10 while everyone else is arguing over whether support exists here or not, now you know why. Focus on what's objective. Psychological levels don't change, they're the market's universal language, and when you understand that, you start thinking more like the institutions that actually move the market. Now this next one is huge, and it's something 99% of traders completely overlook. Always have Oanda's order book open when you trade. Let me tell you why. Price action isn't just candles moving up and down, it's the result of where orders sit in the market. When you can actually see those orders, you're no longer guessing where reversals or stop hunts might happen. You can see them forming in real time. Oanda's order book gives you that insider style visibility. It shows where traders are long, when they're short, and most importantly, where their stops are sitting. Think of it as like having X-ray vision for the market. When you notice a cluster of stops just above a major psychological level, that's your warning sign. Price doesn't just randomly reverse. Liquidity gets targeted. Market makers push through those stops, grab the liquidity, then price reverses. For example, if Euro USD is sitting at 1.0990 and you see a huge pocket of buy stops just above 110, that's not a breakout signal, that's a potential stop hunt. You wait, let the sweep happen, and then you trade with the reversal, not against it. And the beauty of the order book is that it turns what it used to be invisible, which is trader positioning, into something you can actually measure and act on. Let's take a look at this example on USD Japan, because this is exactly why you always want to have the order book open. Check out the left hand side. The orange bars represent sell orders, the green bars represent buy orders. Notice how there's a big block of buy orders sitting right below the recent lows. That's your first clue. When you see a build-up like that, it means traders are placing buy limits or getting stopped out in that area. In other words, liquidity is waiting there. And what happens next? Price dips just below those lows, triggers all the orders, and then immediately snaps back up. That's a classic stop hunt. The order book made that move predictable. You didn't need to guess or rely on a trend line. The data literally showed you where the stops and pending orders were already sitting. Institutions love these zones because that's where they can fill large positions without moving the market too early. They drive price just far enough to grab that liquidity and then reverse it. So when you're watching the chart and you notice price approaching a level where a bunch of buy or sell orders are stacked, you already know what's coming next. A potential liquidity sweep, a stop run, and then a sharp reversal. That's the power of combining price action with real order flow data. You're not guessing, you're reading the intentions behind every candle. So before you ever hit that buy or sell button, get in the habit of checking Oanda's order book. Over time, you'll start to recognise patterns, where traders trap themselves, where liquidity pools form, and that's when your confidence as a price action trader will skyrocket. Tip number 3, focus on large range candles. Forget complicated patterns or fancy indicators. The most reliable signal you'll ever get is sitting right in front of you. It's the large bodied candle. Here's why. A large range candle, which is typically one showing around a 0.12% gain or loss, represents real momentum. That's not retail traders clicking buy or sell. That's institutional order flow. That's volume, conviction, and commitment hitting the market right now. And this isn't theory. I've proven it in my own spreadsheet. When you track these large candles across hundreds of examples, the data shows something incredible. Once a big-bodied candle forms, the odds of price breaking its high or low are extremely low. In other words, that candle defines control. It tells you who's in charge, buyers or sellers, and from that point forward, the market tends to respect that momentum zone. Think of it like this. Every candle is noise until a large range candle appears. That's the one moment when traders actually commit, when money actually moves the market. So when you see a big bullish candle burst through a level, don't fade it, don't second guess it. Instead, mark it, study it, and use it as your reference point. Because until that candle's range is broken, you're trading with the momentum, not against it. And the beauty here is simplicity. You don't need to overanalyze patterns or rely on lagging indicators. Just identify large range candles, mark their highs and lows, and trade around them. They're the market's purest expression of intent, and when you build your strategy around that, you start trading with precision instead of prediction. And because the low or high of a large range candle holds about 70% of the time in the next 24 hours, these levels serve 3 distinct roles in your execution. You can use them for entries, stop management, and as points to scale into an existing trend or movement. Tip number 4, use the COT report to determine the trend. The Commitment of Traders Report, or COT, is basically a weekly snapshot from the US Commodity Futures Trading Commission. It shows where the smart money are positioning themselves in the market. And here's why that matters. Price action tells you what's happening right now, but the COT report tells you what's been building up quietly behind the scenes. So when you see large speculators increasing their net long positions week after week, that's a clue the underlying trend is turning bullish, even if the chart hasn't actually exploded yet. And when they start unwinding those longs or flipping short, it's an early signal momentum is shifting the other way. If I'm watching Euro USD and the COT data shows commercial hedgers increasing short while large speculators are loading up on longs, that tells me the real trend bias is bullish. So I'll look for my price action setups only in that direction. This keeps me aligned with the people who actually move the market, rather than fighting against them. So if you're serious about trading with the trend, stop relying on moving averages or lagging indicators. Just go straight to the source. Pull up the latest COT report every Friday, look at the positioning, and check if traders have been adding or removing any long or short positions. This will put the current market's trend and price action into context and give you some much needed background on when or if the current trend might. This last tip is massively overlooked, and it's pure gold once you understand it. If price breaks the previous day's high, there's roughly a 70% chance the market will close bullish for that day. And if price breaks the previous day's low, there's a roughly a 70% chance it will close bearish. Let that sink in for a minute. This single simple pattern gives you a directional bias that's right 7 times out of 10. No indicators, no complex analysis, just clean statistical truth about how the market behaves day after day. Let's back this up with some cold hard data. This spreadsheet tracks daily highs and lows, basically whether price made a higher high, higher low, lower high or lower low compared to the previous day. And what I found after analysing over 6,000 trading days across GBP USD is pretty insane. Check this out. When the previous day's high gets broken, meaning we print a higher high, the market closes bullish around 69.41% of the time. That's nearly 7 out of 10 days finishing in the same direction as the break. Now if you flip it around, when the previous day's low is broken, giving you a lower low, the market closes bearish about 67.29% of the time. So it doesn't matter if you're looking at a higher high or a lower low. Once that level breaks, the market usually keeps moving in that same direction until the daily close. Why is this? Well, it's because price breaking the previous day's range is proof of control. It tells you momentum has shifted decisively, buyers or sellers are in charge, and the rest of the session is typically just follow through. And if you look closely at the summary here, you can see bullish days make up about 50.76% of total trading days, whereas bearish days are 49.24%. So that's nearly a perfect 50-50 split overall. But when you isolate only the days where the high or low gets broken, the probabilities skyrocket, which is your edge. This is the kind of statistical insight most traders never understand or look at. They chase setups, but they don't measure how the market actually behaves. So when you're watching price break yesterday's high or low, you're not guessing anymore. The data says there's roughly a 70% chance you already know how the day will close. That's what real price action trading is about, not prediction, but probability. And when you combine this rule with the other tools we've covered, so your psychological levels, the order book analysis, large range candles, and the COT data, suddenly you're not guessing anymore. You're trading with the probabilities on your side. And that's the difference between reacting emotionally and trading with conviction like a professional. Institutions don't trade noise. They trade structure, they trade liquidity, they trade intent. If you apply these 5 price action principles consistently, you'll start seeing the market differently. You'll stop reacting to candles and start anticipating where the real money is positioned.